Brought to you by Phoenix Nest Homes and sponsored by Kremer Realty. In the world of global trade, tariffs are like taxes imposed on imported goods. Recent tariff implementations, particularly on goods from China, have sent ripples through the U.S. economy, significantly impacting real estate and construction. These tariffs directly affect the cost of essential building materials like steel and aluminum, causing a surge in construction expenses. For instance, the 25% tariff on steel imports directly translates to higher costs for developers, ultimately impacting the final price tag of new homes and commercial buildings. These increased costs are not merely numbers on a spreadsheet, they have real-world consequences. Developers face tighter budgets, potentially leading to project delays or even cancellations. Renovation projects, too, are feeling the pinch, with homeowners experiencing longer timelines and higher price tags for renovations. The uncertainty surrounding tariff policies further exacerbates the situation, making it challenging for industry players to forecast costs and plan effectively. The impact of tariffs on construction costs is not uniform across the nation. Regional differences in building regulations, labor costs, and the local supply and demand dynamics for housing contribute to varying levels of impact. For instance, areas with robust construction pipelines and high demand for housing, like bustling metropolitan areas, are likely to experience more pronounced price increases compared to regions with slower growth. This disparity highlights the complex interplay of tariffs with local market factors. Beyond the direct impact on construction costs, tariffs indirectly influence the real estate market through their effect on mortgage rates. The complex interplay between tariffs, inflation, and the bond market plays a crucial role in determining the cost of borrowing for homebuyers. Tariffs contribute to inflation by raising the prices of imported goods, prompting the Federal Reserve to adjust interest rates to keep inflation in check. Consequently, mortgage rates rise, making home loans more expensive. This rise in mortgage rates can dampen housing demand, especially for price-sensitive buyers. As borrowing costs increase, potential homebuyers may find themselves priced out of the market, particularly in regions where affordability is already a concern. However, other economic factors such as employment growth and wage levels also influence housing demand. Strong local economies with robust job markets can partially offset the negative impact of higher mortgage rates, as people remain optimistic about their financial prospects and continue to invest in real estate. The current real estate market presents a fascinating paradox. Despite rising mortgage rates driven in part by tariff-induced inflation, housing demand in many regions remains relatively strong. This can be attributed to a combination of factors including pent-up demand from previous years, a shortage of housing inventory in desirable locations, and continued low unemployment rates. However, the sustainability of this demand in the face of persistent inflationary pressures remains a key question for both homebuyers and sellers. Tariffs have further exacerbated existing supply chain disruptions, creating significant challenges for the real estate industry. The global interconnectedness of the construction industry means that materials often traverse continents before reaching their final destination. Tariffs, coupled with geopolitical uncertainties and transportation bottlenecks, have led to delays and increased costs for essential building materials. This has slowed down construction timelines, impacting both residential and commercial projects. The luxury real estate market, often reliant on high-end imported materials and fixtures, faces unique challenges in this environment. From Italian marble countertops to German-engineered appliances, these bespoke materials often come with hefty price tags, further inflated by tariffs. This situation has put pressure on developers of luxury properties to adjust their strategies, either by absorbing the increased costs, seeking alternative sourcing options, or in some cases, delaying projects until the market stabilizes. The impact of tariffs on the luxury market extends beyond construction costs. The economic uncertainties created by trade tensions can also influence buyer sentiment. High net worth individuals, while less affected by mortgage rate fluctuations, are not immune to market volatility. Concerns about global economic stability and potential depreciation of luxury assets might lead some investors to adopt a wait-and-see approach, potentially impacting sales volumes in this segment. Navigating the current real estate market, characterized by tariff-induced uncertainties, requires adaptability and strategic planning. For prospective homebuyers, this might involve adjusting budget expectations, considering properties that require less renovation, or exploring alternative financing options. Locking in mortgage rates early can provide some protection against future interest rate hikes. Thoroughly researching local market conditions and consulting with experienced real estate professionals can provide valuable insights. Developers, facing escalating material costs and supply chain disruptions, must adapt their strategies to mitigate risks. Exploring the use of alternative building materials, such as domestically sourced options or innovative substitutes, can help manage costs. Strengthening relationships with local suppliers and contractors can enhance supply chain resilience. Additionally, clear communication with buyers about potential price adjustments or project delays is crucial for managing expectations. For investors, the current environment demands a cautious yet opportunistic approach. Diversifying portfolios across different asset classes and geographic locations can spread risk. Closely monitoring market trends, particularly interest rate movements and inflation data, is vital for making informed investment decisions. Seeking expert advice from financial advisors and real estate professionals can provide valuable insights and help navigate the complexities of the tariff-impacted market.